Welcome to Talk Tickers.
Today, we're plunging into a really deep current running beneath the retail financial markets. We're talking about the proposed elimination of the pattern day trader rule, the PDT rule.
Yes. If you are an active investor, or honestly, even just curious about how markets work, you know this rule.
In fact, you know it.
For over 2 decades, it's been this major financial constraint that has really defined the landscape for the individual trader. It's basically a massive $25,000 capital gate.
That's right. It restricts frequent trading for anyone using borrowed money or margin unless they can keep that pretty significant equity threshold.
And it's not just some technical rule, right? It's a policy that has fundamentally shaped who can trade actively and how they have to manage their risk.
Exactly. And our mission today is not just to define the old rule. We want to compare it with the groundbreaking changes Finra is proposing.
We're going to show you how they're planning to move away from these fixed capital requirements and embrace something more like real-time risk modeling.
And that shift could fundamentally change market accessibility and risk standards for everyone.
Okay, so let's start with the hard numbers that everyone kind of hates. What is the precise definition of a pattern day trader under the current Finra rules? What actually triggers that label?
So the definition is very specific. You get flagged as a pattern day trader if you execute 4 or more day trades within any rolling period of 5 business days.
4 trades in 5 days.
Okay. And this is the critical qualifier that people often overlook, those 4+ day trades also have to represent more than 6% of your total margin account activity during that same 5-day window.
Okay, so there's a volume component too. And a day trade itself is pretty simple, right? It's just buying and selling the same security on the same day.
The same day in a margin account, yeah. And that applies to stocks, options, ETFs.
Simple enough.
Exactly. But here's where we get into some of the, strange structural inconsistencies of the current regulation. Well, the rule is broad. Yes, it applies to stocks and options, but it has these very specific, deliberate exclusions.
Oh, right. So the PDT rule doesn't apply to highly leveraged products like, futures?
Futures, options on futures, and Forex trading. They're all exempt.
That's a fascinating contradiction, isn't it? I mean, regulators create a rule to protect small accounts from excessive risk-taking, but then the most volatile, highly leveraged products are just left out.
It really speaks to the siloed nature of regulation back in the early 2000s. And the result, of course, was that these products became the go-to for many undercapitalized retail traders.
Precisely because they allowed for unlimited trading frequency.
Even though they carried inherently higher risk profiles, it was a classic case of a rule, intended for protection, inadvertently pushing risk into different corners of the market.
But for those who do get caught by the rule in the stock and options market, we come back to that infamous $25,000 barrier.
That $25,000 threshold is the cornerstone of the whole thing. If your account gets flagged, you have to deposit and continuously maintain that minimum equity before you can do any more day trades.
And it's a hard floor. You can't, say, combine funds from different accounts to meet it, right?
Not at all. Each trading account has to stand on its own above that $25,000 line.
That is just a monumental hurdle for a new trader. And the penalty for slipping below that threshold or for making that 4th trade by mistake, it's severe and immediate.
It's genuinely punitive. Your account could face a 90-day freeze. During that time, you're restricted to trading strictly on a cash available basis.
You have no margin, no short selling, nothing.
Nothing. And that freeze only lifts if you fund the account back over $25,000. And what's more, this restriction is at the user level.
Meaning?
If you violate the rule on broker A, broker B and broker C will also flag you if the accounts are linked. It can effectively neutralize all of your margin access everywhere.
Wow. It just highlights how rigid the rule is. It punishes the trader not just for losing money, but just for the frequency of trading, whether the trades were good or bad.
And to really understand the intensity of those restrictions, we have to go back in time. We've got to travel back to 2001.
Right.
The PDT rule, Finra Rule 4210, was a direct, forceful response to the extreme market conditions after the dot-com bubble collapsed.
That's when day trading exploded, right? He moved from Wall Street desks to home computers, and the story was that anyone could just quit their job and trade from their garage. What was the SEC trying to contain?
Regulators saw 2 huge interconnected problems that were just destroying small investors. First was the widespread use of margin borrowed money by retail investors who had very little financial cushion.
So when the bubble burst,
catastrophic margin calls. People ended up owing massive debt back to their brokers. The $25,000 barrier was meant to be a capital buffer, a way to ensure that if the market suddenly turned, the trader could cover the loss.
So it was less a trading restriction and more of a debt protection mechanism.
Wow.
For both the customer and the brokerage.
Precisely. And the second reason is one that's almost completely forgotten today: transaction costs.
Oh, that's a good point.
To put this in perspective, back in 2001, a single trade might cost you $15, maybe $20 in commission.
Each way.
So if you're doing 10 round-trip trades a day, you could easily be spending $200 just on commissions. It made it almost impossible to profit on small moves.
And that entire rationale has just evaporated in today's world of zero commission trading. It makes the rule feel so incredibly anachronistic.
Absolutely. And beyond the costs, the leverage limits were also very strict. If you were flagged, your leverage was capped at 4 times your excess margin from the day before. Exceed that.
And you get the dreaded day trading margin call.
Which is not forgiving. You get 5 days to meet it, or it's 90 days of cash-only trading.
By setting this high barrier, weren't regulators basically creating a 2-tiered system where, your ability to trade flexibly was defined by your wealth, not your skill?
That is the core criticism that's been leveled against the PDT rule for years. Many traders argue that the threshold is just exclusionary. And even worse, it forces small accounts into bad risk management.
How so?
Well, say you take a bad trade and you've already used your 3 trades for the week. You can't just take the small loss and sell. You have to hold the position overnight to avoid the PDT flag.
So you're forced to turn a day trade into a swing trade, just hoping the market turns around, which is what small accounts call bag holding.
And it often turns a manageable loss into a catastrophic one. The system was clearly broken for small accounts.
So because the rule was so rigid, traders just got creative. They became masters of evasion.
Exactly. They developed all these sophisticated strategies just to navigate or get around the PDT rules.
So what are the main avoidance tactics people are using today?
Well, the most common route is using a cash account. Those are totally exempt from PDT rules. You can trade as often as you want.
But there's a catch.
A huge one. The settlement period. Until very recently, cash from a sale was stuck for 2 business days, T+2. So if you sell something on Monday, you can't reuse that cash until Wednesday.
Which means a trader with, say, a $5,000 cash account can only really use about 1/3 of their capital each day. It sounds like an administrative nightmare.
It is. The second popular workaround is just splitting your capital. A trader might open multiple margin accounts with different brokers.
So since the flag is usually applied by the brokerage.
Right. You could split, say, $10,000 across 4 different accounts. And that theoretically gives you 3 day trades in each one. So 12 trades a week instead of 3.
It's an administrative way to quadruple your frequency. And of course, there's the strategy we mentioned, holding overnight. But that comes with its own risk of a big gap against you.
A big risk. And finally, the riskiest option, offshore brokers.
I've heard of these.
They aren't subject to Finra rules, so you get unlimited trading, but you're introducing massive counterparty risk. There's just a lack of regulatory oversight and insurance.
It seems like the very existence of all these complex workarounds proves the rule failed. It just pushed traders into more complex or riskier situations. And that brings us to the key point, this monumental shift that's underway.
Yes. Finra finally seems to agree that forcing small traders to bag hold or use risky offshore accounts was actually worse than the risk they were trying to prevent. They've filed a proposed rule change, SR SINRA 2025-011, that basically says the entire PDT framework is obsolete.
Okay, so what's the core proposal? What replaces this decades-old structure?
The core change is just eliminating the entire pattern day trader framework, the definition, the 3 trade limit, and crucially, the mandatory $25,000 minimum equity requirement. All of it.
So if that strict, backward-looking $25,000 barrier is gone, what replaces it? How do you make sure brokers aren't encouraging reckless leverage?
They're shifting from a rule based on fixed capital to one based on dynamic risk management.
Okay.
The new focus is on implementing sophisticated intraday margin standards. So instead of counting your trades from last week, brokers will be required to determine a customer's intraday margin deficit, or IMD.
Okay, let's slow down here because this is where the policy gets really interesting and technical.
Yeah.
This is the heart of the deep dive. Explain the conceptual difference between the old rule and this new intraday margin standard.
Okay, so think of it this way. The old PDT rule is like a fixed speed limit on a highway, say 65 miles per hour.
Right. Doesn't matter if the road is empty or covered in ice, the rule's the same.
Exactly. 25 grand or you're restricted. This new intraday margin standard, the IMD, it's more like a smart car. It's constantly monitoring real-time traffic, weather, road conditions.
And it adjusts your speed dynamically based on the current risk.
Precisely. It's looking at the actual risk you're presenting to the broker right then and there.
I see. So the broker is no longer just checking a box. Does this trader have $25,000? They're constantly monitoring the margin impact of every single trade in real time.
Exactly. And this shifts a massive amount of responsibility and a technical burden onto the brokerage houses. They're strongly encouraged to use real-time monitoring to calculate your intraday margin level, or IML, and block any transaction that would push you into a deficit.
So they stop the risk before it happens.
That's the idea.
And how complex is that calculation? I mean, will smaller brokerages even be able to afford the tech for that, or will this just favor the big players?
That's one of the key questions. Finra does provide an alternative for, let's say, less technologically advanced firms. They can do an end-of-day calculation that reflects the largest margin deficit the account faced at any point during the day. But the real-time approach is clearly better at managing that instant risk.
And this modern approach, it finally addresses the risks from new products, right? Like the zero data expiration, the zero DTE options that have just exploded in popularity.
That is the primary driver of this overhaul. Zero DTEs can have such catastrophic losses late in the day, and the old rule just wasn't built to handle that. The new IMD framework is specifically designed to manage that acute, rapid, intraday leverage risk.
Making sure a broker can cut a trader off mid-trade if things are going south fast.
Exactly.
Beyond the structure, there's a lot of talk about the minimum capital floor itself just dropping dramatically. We've seen industry pressure pushing that $25,000 number way down to what figure are we hearing?
The industry, led by the big brokerages who see millions of potential new clients, has centered its pressure on lowering the barrier to just $2,000.
$2,000. That's a 92% reduction. If that goes into effect, coupled with no 3-trade limit, that would be the single greatest democratization of trading access in the modern era.
It would be. It moves the ability to use flexible margin trading from the relatively wealthy to almost anyone with a brokerage account.
It really acknowledges that the old reasons for the rule are gone.
Right. The high commissions are gone, and now we have, or will have, these superior real-time risk tools to manage the leverage.
So we've established this is a seismic shift.
Yeah.
We're moving from a single, rigid, clearly defined capital boundary to this flexible, broker-defined, real-time risk assessment model. We asked the question earlier, but now that we've seen the mechanics, let's really revisit it.
As Finra moves toward this real-time risk assessment, will the transition from that rigid $25,000 barrier to a flexible, broker-defined margin standard truly democratize market access? Or will it just shift the risk burden from the regulator onto the individual brokerage and, ultimately, onto the less capitalized trader?
And here's where transparency is everything. The success of this whole thing really hinges on how transparent and consistent the new house requirements are, and the rules the brokerages themselves choose to enforce above that proposed $2,000 minimum.
Yeah. If different brokers enforce wildly different rules, small traders could find themselves just as restricted by the new system, even if they have the $2,000.
It just becomes a new kind of black box.
It could.
So to wrap up, this proposed overhaul is it's revolutionary. We're finally retiring a strict, backward-looking rule that was based on 2001 concerns about high commissions and margin debt.
And replacing it with a modernized, forward-looking, real-time risk management system, one that's actually designed to address the volatility of new products like zero DTE options. And that potential reduction to just $2,000 could open the market to millions.
But for you, the individual trader, you have to always remember, the market does not care about regulatory minimums.
Not one bit.
Trading is a business. It requires capital. It requires intention. And lowering the regulatory barrier doesn't in any way lower the actual risk that's inherent in using leverage.
In fact, you could argue that if $2,000 is the new barrier, the potential for losing 100% of your account is just amplified by the new freedom of unlimited instantaneous trading.
This deep dive into the pattern day trader rule overhaul was customized for you based on the most current regulatory filings and industry discussions. And the question for you to mull over is this. If the barrier drops to $2,000, Will the sheer volume of newly engaged, less experienced day traders create a new systemic form of instability in highly concentrated volatile assets?
Share your thoughts on that possibility or any other questions you have about the intraday margin standards for future deep dives.
We'll be back soon with more Talk Tickers analysis.